It leaves the checking account the same way it always has, quietly, without ceremony, long after the initial paperwork was signed at a dining room table that felt too small for the stack of disclosures. The amount has changed once, after a refinance during a period of lower rates, but the presence of it has not. It has remained the central line item around which everything else arranged itself. In the early years, the payment represented arrival, a fixed rate, a predictable obligation, a house in a good school district, a yard large enough for a swing set that stayed up longer than anyone expected. The monthly draft felt responsible, stable, adult. Rent would no longer increase without notice. There would be no landlord deciding to sell. The roof and the driveway belonged to them, along with the repairs that came with both. At work, income rose in uneven increments. Promotions came slower than anticipated, but steady enough to justify the house purchased in the early 30s. The mortgage was structured at 30 years because that was what most people did. The payment fit cleanly within the standard debt to income ratios. The bank approved it without hesitation. For a long time, the house absorbed more than shelter. It held holidays, graduations, illness, and routine. It anchored job decisions. It made career changes more deliberate. There was always a calculation in the background. Could the payment still be covered if the bonus didn't arrive? If a role was eliminated? If one income paused for a year? The fixed rate created a sense of protection. While rents in nearby neighborhoods climbed, the principal and interest portion of the payment remained the same. Property taxes increased gradually. Insurance premiums rose more noticeably over the last decade. Maintenance arrived in waves. A new furnace, exterior paint, appliances that failed in clusters. But the core number never moved. That consistency shaped behavior. Retirement contributions increased slowly, often after annual raises. In the beginning, it was enough to capture the employer match. Later, contributions inched upward, but rarely to the annual maximum. There was always the mortgage, and then college savings, and then health insurance premiums that grew heavier each year. The house appreciated, at least on paper. Online estimates climbed steadily, particularly during periods when housing demand surged. Neighbors sold for prices that would have seemed improbable a decade earlier. Equity accumulated without effort, reflected in statements that arrived once a year, showing a principal balance gradually shrinking. It felt like progress. In conversations with peers, the house became shorthand for stability. The phrase, locked in at a low rate, carried weight. Refinancing at the right time became a quiet victory. The new rate shaved a few $100s off the monthly payment and shortened the term slightly. But it did not fundamentally alter the timeline. Retirement was still projected for the mid 60s. By the early 50s, the mortgage balance had fallen substantially. The remaining term stretched another 8 years. The children were nearly finished with college. One had already moved out. Bedrooms that once contained noise and schedules and late night activity became quieter. The house itself did not shrink, but its function changed. Property taxes, however, did not decline. Insurance costs continued to adjust upward, reflecting regional weather patterns and rebuilding costs. Utilities rose gradually. The mortgage payment, though fixed, existed inside a larger set of housing expenses that moved unpredictably. Retirement accounts had grown, but not dramatically. Market returns had been uneven over 2 decades. There were years of strong gains and years of flat or negative performance. Contributions were consistent but never aggressive. There had always been something else requiring cash flow: a vehicle replacement, medical bills not fully covered by insurance, tuition gaps. The original decision to choose a third-year term had felt prudent. It preserved flexibility. The lower monthly payment allowed room for other obligations. It aligned with common practice. Few in their early 30s selected a 15-year term while raising young children and managing childcare costs. Now, in the late 50s, the timeline feels different. The mortgage is scheduled to be paid off at age 63. Retirement has been tentatively circled at 65. The plan, long assumed, was that the house would be fully owned just before leaving full-time work. No rent, no principal and interest, a simplified monthly budget. But the numbers, when laid out in detail, do not fully align with the earlier assumption. The retirement account balances are meaningful but not abundant. Social Security projections reflect steady earnings history but not extraordinary wages. Healthcare costs after leaving employer coverage are projected to be significant. Even without a mortgage payment, housing expenses will remain: taxes, insurance, maintenance, utilities. The mortgage payoff date, once a distant milestone, now sits within a decade. It represents relief, but not transformation. The payment that once consumed a substantial portion of income now feels proportionally smaller, not because it shrank, but because income increased over time. Inflation works slowly in the background. The realization did not arrive all at once. It emerged gradually through annual benefit statements and retirement calculators that required updated assumptions. The equity in the home is substantial, but it is illiquid unless the house is sold. Downsizing has been discussed in abstract terms but not committed to. The neighborhood feels familiar. The routines are established. Colleagues the same age are making different calculations. Some accelerated mortgage payments years ago, applying bonuses and tax refunds to principal. Others carried larger balances due to cash-out refinances during renovations. A few rented throughout their careers and invested the difference. Outcomes vary. In this household, the mortgage structured the financial life for over 2 decades. It provided stability during volatile job markets. It anchored the family geographically. It prevented the type of rent escalation seen in urban centers. It delivered appreciation that now appears significant. Yet retirement timing is not earlier because of it. The fixed payment allowed predictability, but it also created a ceiling on how aggressively retirement savings could grow in the early and middle years. The years when compound growth might have had the most time were the same years when housing costs dominated the budget. There was never a dramatic crisis, no foreclosure scare, no missed payments. The mortgage was always manageable. It simply occupied space. As the payoff date approaches, attention shifts subtly. The final years of payments feel heavier, not because they are larger, but because they are so clearly counted. Each month reduces the balance, but it does not change the broader retirement projection in a dramatic way. The house itself requires more maintenance now. The roof will likely need replacement within 5 years. Aging systems demand attention. The property taxes reflect higher assessed values. Insurance premiums incorporate broader regional risks. Owning the home outright will eliminate principal and interest, but it will not eliminate the costs of owning. There is an awareness that the mortgage, once seen as the defining long-term obligation, was only one component of a much larger financial structure. Retirement timing depends on accumulated assets relative to expected expenses, not solely on the absence of a mortgage. Some evenings, sitting at the kitchen table after dinner, statements are reviewed with a different lens. The projected retirement date shifts by a year, depending on assumptions about healthcare inflation or market returns. The mortgage payoff date does not move, it is fixed. The discipline of making that payment for decades built a record of consistency. Credit scores remain strong. The house stands solid. The neighborhood matured. Trees planted in the first year now provide full shade. There is pride in that continuity. At the same time, there is a recognition that stability has its own cost. A 30-year timeline extends across nearly an entire working life. The house that felt perfectly sized at 32 feels large at 58. Rooms sit unused. Cleaning takes longer. Heating and cooling expenses do not adjust downward simply because fewer people occupy the space. Selling would unlock equity. It would change the retirement equation meaningfully. But it would also dissolve the stability that shaped 2 decades. The mortgage payment, once a burden, became a background constant. Its disappearance will not automatically create abundance. The original assumption was linear. Buy in early adulthood, pay for 30 years, retire shortly after. Life did not unfold in a straight line. Career growth was slower than modeled. Healthcare costs were higher. College expenses outpaced early projections. Market downturns reduced account balances at inconvenient moments. The mortgage remained steady through all of it. In retrospect, the stability it provided was real. There were no forced moves, no sudden rent increases, no uncertainty about renewal terms. That predictability had value beyond numbers. It reduced stress during job transitions. It created continuity for children in school. But the stability also delayed certain financial inflection points. The lower monthly payment of a 30-year term compared to a shorter one allowed more flexibility early on. Yet, it extended the obligation well into the years when retirement planning becomes urgent. Now, as retirement age approaches, the absence of urgency in earlier decades is visible in the account balances. They are respectable but not transformative. The mortgage payoff will improve monthly cash flow, but not enough to eliminate the need for continued income for several more years. The house stands as both asset and anchor. The final amortization schedule shows the last payment dated in late spring. It has been printed and placed in a folder. The number of remaining payments is countable. The retirement date remains penciled in, dependent on portfolio performance and healthcare premiums. Morning light enters the kitchen through the same window it did when the first payment was mailed. The countertops have been replaced once. The cabinets remain. The neighborhood is quieter now. Some neighbors have moved, others have retired. The mortgage draft continues to leave the account on the 15th. It has always felt responsible. It still does. But the calendar reflects that responsibility carried a length that only becomes fully visible near the end. The house is nearly paid for. The working years are nearly complete. The alignment between those two timelines is close, but not exact. Retirement will not begin the month after the final payment clears. The mortgage will end. The broader financial structure will remain.